Good day, everyone, and welcome to today's webinar. Today's webinar will be on the impact of the recently enacted Finance Act 2021 on the consumer and industrial product and services industry. I am Babatunde Olani, and I'm a senior manager within the tax unit in PwC Nigeria. And today, the webinar will be divided into two phases. The first phase will be a 30-minute presentation by Esiri, and the next 30 minutes will take your questions and your contributions. That session will be moderated by Ademola Idowu. To introduce our first speaker, Esiri. Esiri is a partner in tax within the PwC Nigeria firm. She drives the tax practice within this industry. She has many years experience of compliance, international tax structuring, local tax structuring, tax advocacy and policy, right? And I would say you are in great hands. Now, the target list for this webinar, right, was very uniquely devised. So we sent you special invites, was not very general, right? So because we felt that in order to ensure that the conversations today are quite robust, right, the people in the room need to understand how the impact of the Finance Act affects their companies within this industry, and they can basically ensure that we make this session a very robust learning experience for both of us. Now, I would say that this session is being recorded for reference purposes, and this will be sent to you during the Q&A session. If you want to make a contribution or you want to ask a question, please raise those comments and questions within the chat box, right? And Demola will be happy to pick that up. Now, in terms of if you want to speak up or you want to put some context to your questions or contributions, please raise your hand and we would unmute you to speak. So at this particular point in time, I hand over to Esiri to take us through the presentation. Over to you, Esiri.
All right, thank you, Babatunde. Because I'm sharing the screen, I always have to squint my eyes just to look that I'm clicking on the right button. All right, thank you so much for the introduction, Babatunde, and welcome to everyone who's joined the panel. It's really an honor for us to be able to share our insights on the Finance Act, and particularly grateful you could join. Please do feel free to put your questions in the question box or in the chat box, and we will strive to answer those in the Q&A session. To cover this session, we would specifically look at a brief introduction to the Finance Act, just in case if you haven't heard anything at all, at least you get some thoughts around what it covers and what it entails. Then we would go in depth in some of the key issues that would affect the industry, and also add on some tips just for staying ahead. Some of the amendments, just to add, have practical implications. In some cases, there are gray areas. It's not unlikely that you have such, because with every Finance Act, there's always something to just update. The good thing is we've started doing this more frequently than before. So just a quick overview of the manufacturing industry, which was really hit by the pandemic in 2020. As you would see from the graph, a very significant dip in the negatives. And we're only just beginning to come out of that recession at the time. But the good thing is you can see then an upward rise coming even into 2021. And we're hoping that that would hopefully be sustained, going into 2022. That really depends on how we're able to expand the economic activities within this region, and also underpinning that would be the fiscal and monetary policies which are being driven by the FA 2021. So as I go through the amendments, hopefully you get some points for planning, but at the same time, where we do find challenges, please be sure to spot those as well, because those would always be your underline for planning. And it's important that we don't miss those, because then what you stand to save really is cash. So let's just dive into the key changes that we had from the Finance Act. And I'll start first with Companies Income Tax Act. just for the purpose of those who are also here and maybe haven't heard this before, the Finance Act sought to amend several acts, including the Companies Income Tax Act, the Tertiary Education Tax Act, the Stamp Duties Act, Customs Duties Act, just name it. That's the module that's used for those amendments. And it doesn't then override in totality the existing acts. Those acts are not abolished by these amendments. They are just there to add on to them. And then you have to read it within the context of the foundational act. So the first thing that we'll just look at here is around capital allowance restriction. Generally, companies are allowed to claim a capital allowance deduction, which is a deduction of the cost you've incurred on your assets to the extent that they are qualifying. On the other hand, the tax laws do not allow you claim the accounting depreciation or the book depreciation. Now, the amendments through the Finance Act 2021 is specifically excluding taxpayers from claiming capital allowances against exempt income. This was an introduction that was made in the previous Finance Act. But what this has gone on to do is specifically restrict what you can then deduct for capital allowances. And so what it's saying is those allowances will be prorated according to the percentage of taxable income and exempt income that you have. So if you have income that's arising from your operational activities that are taxable, all good and well. If you then have exempt income, perhaps coming from capital gains, if any, that are still exempt, or maybe from some instruments like FGN bonds that may be exempt, you then have to do percentage and look at how much they compare to each other. Once your exempt income exceeds 20% threshold, you would not be allowed to claim the capital allowances prorated on that basis. So you forfeit them basically. And this raises a lot of questions around what will my deferred tax balances then look like? And what will my pool for capital allowances be like? How do I then do the apportionment? Should the apportionment apply to prior year capital allowances that I've accumulated, or it should only be for capital allowances that I have generated in the specific period? So those are the many questions that it raises, and something to just note, because definitely this will affect your cash flows as you claim them. And it's very important that that's gotten right. The next thing is around small and medium companies. In previous Finance Acts, we had a definition for small and medium companies, which include those which turnover of 25 million being small companies who were then exempt. And then over that, up to 100 million, we had 120 million, we have medium companies who have a reduced rate of taxation of 20%. And to pretty much give some equity of, the extent of capital allowances you can carry forward, especially when you get into periods that you are then taxed at a higher rate, say 30%. This is saying that that restriction also applies to you cannot bring forward the allowances you enjoyed as a small or a medium company into periods where you then be taxed at a higher rate. So you basically forfeit them. But it excludes pioneer. The reason it excludes pioneer companies is under the Enabling Act, which is IDITRA, the Industrial Development Act, you have a section that allows you to assume that the assets that you acquired during that pioneer period were incurred or acquired on day one post-pioneer. So it doesn't come into this bucket. The next amendment we saw was the reduction in minimum tax. And we were all excited about this one because it was a very good response by the government to the period of the recession. And so what had happened was 50% reduction in the minimum tax rate from 0.5% to 0.25%. And just to go back in time a little bit, we had a redefinition of the base for minimum tax. So it was simplified from about 4 cardinal points on taxation to just the turnover from the financial statement. So simple, easy to calculate. But then the issue was around the fact that we were in recession. A lot of companies were not recognizing profits as well. And so this was reduced after much advocacy that was done by an industry. So we now have it from 0.5 to 0.25%. However, there was an issue with the language in the act at the time, which suggested that you had to go back in time to claim a refund for the 2019 period that you had filed, and also take that deduction for 2020. And it posed a big issue with the tax authorities pretty much denying that claim to taxpayers and writing letters back and forth. What the response of the government has now been is to say, okay, it's fine, you can go ahead, claim your 2019, you can go ahead, claim your 2020 if you do wish to. It has now extended that period to 2021, and then furthermore, giving taxpayers an option to choose which year you should claim. So if you have not claimed it or you were stopped because of some of the obstacles that the tax authorities put, you now need to consider which of the 2 years you would like to claim. Is it 2020 and 21 or 2019 and 2020? But you cannot claim more than those 2 years. For the timeline for payment of tax assessment, there's a specific record for tax payable within 30 days of an assessment. And this is in direct response as well to some of the notices that the tax authorities can now also give to taxpayers on, sorry about the intro disturbance. Let me just switch off my phone. Can give to tax payers. And then the last one would be around the installment of self-assessed taxes, with taxpayers having a discretion for installment CIT payment, but the final installment being payable by the due date of filing. So let's just go further down, break it down a bit more as well for the other acts that were, amended. A key one that affects this industry is the Capital Gains Tax Act. Prior to now, we had a generous exemption on shares, where shares were not considered chargeable assets. And so if there was any capital gain on the disposal of those shares, whether it was in a foreign company or a local company, whether it was a private company or a listed company, the gains will be exempt. Now, the Finance Act 2021 has removed that exemption, but introduced a threshold, which is about 100 million. So if you sell those shares and your proceeds are 100 million naira and above, in any 12 consecutive month period, you would have to assess the capital gain and then charge the tax at 10%. So it's the gain you will pay the tax on, not on the proceeds, but the proceeds are used as the threshold or the benchmark for determining whether you get into the taxable zone. There are, however, exemptions as well, and those exemptions will be to the extent that you reinvest those proceeds in those shares that you disposed of, or those same category of assets that you had disposed, maybe not specifically the same company, obviously, but those asset categories, the same. If you roll over that and invest those proceeds, you then don't have to pay that capital gain, and you basically would have deferred it to a later period. There is also a proportionate charge that is applied to it, depending on how much you have reinvested. On the Tertiary Education Trust Fund, we unfortunately have an increase in the rate from 2% to 2.5%. Not many people like this, sorry, but the government is looking for money in any way they can. And I think as taxpayers, it just sends a note of warning on what we need to do differently to manage some of this. So increase to 2.5%. There's a 30-day payment timeline following the FRS assessment, although traditionally, the education tax is filed alongside the company's income tax on a self-assessment basis. So not many people wait for this, but it poses itself as an opportunity for you to then think of how you manage your cash flow. So you may want to say, oh, why don't I wait for the assessment as opposed to doing the self-assessment, 6 months after your year end, but up to you, obviously. Under the cost Customs and Excise Tariffs Act. This made the rounds. A lot of media houses were talking about this. Excise duties have been introduced at 10 naira per liter on non-alcoholic, carbonated, and sweetened beverages. A lot of questions arise on this. At what point should the excise duty be charged? Is it at the point of manufacturing? Is it at the point of distribution? Is it at the point of importation? 2, what kind of beverages should this excise duty apply on? Is it non-alcoholic good? The 3 conditions have to meet simultaneously, or it would be the individual product. So once it is non-alcoholic, it should be charged, or once it is carbonated, it should be charged, or once it is sweetened, it should be charged. These are some of the questions arising. And of course, if I were going to add a on every liter that I sold, is a fractional amount that you then introduce into the pricing of the goods, which is not commensurate with the type of currencies that we dole out on a day-to-day basis. So we expect, based on our simulation, that prices of goods will rise to cover this, because this is going to be an indirect tax that can be passed on through the increase in prices, will rise about 5% to accommodate these excise duties. So something to think about as well if you fall in that bracket. But another thing we note just from the language in the act is that the beverage definitely has to contain all of this. So it should be non-alcoholic, carbonated, and sweetened. However, we feel that the tax authorities may want to push for the individual or selective isolation of those beverages to assess the duties. The other thing as well that I would like to point out here is just the rationale behind the tax itself. And it's one of the reasons why, at least I'm optimistic that there might be some further amendments down the line. And this is only a starting point to get us to where we want to be. Some of the thinking behind this was really around the health of the nation, and where are those areas that we could achieve at least some national good in terms of the health of our people, but also at the same time, capture some wins from a financial perspective to cover the deficits that we have. And the more important reason that taxes definitely are required to fund the budget. That was the thinking behind this. Unfortunately, there wasn't much thought given to what kind of sweetener is used for the beverage, because truly we do have alternatives to sugar, for instance, and sugars are unhealthy. We have healthy sugars definitely, but this has just put everything in the same bucket. The second consideration as well is, do we really suffer obesity in this jurisdiction or in this climate? And is this supposed to be a top issue of concern for the government? The alternative argument is we shouldn't wait until we get to such a point, but we should start to think about acting proactively, especially as it relates to diabetes. Another food of thought is sugar is not the sole cause of diabetes itself, so maybe we're attacking the wrong beverages. So we expect that there would be more thought given into the rationale behind this. And it's also a call for manufacturing companies to start to think of, how can we lobby this? How can we advocate for the right change and in the right direction, seeing the massive increase that this may portend, especially for those who would drink it. The products affected here are very much inelastic, so you can expect that there would be reduction in demand. And once that demand reduces, it also then affects the economic cycle that we just looked at. Do we expect that to continually grow or not? Is some of the questions that will be raised. So a good thing to now start to think ahead of the next finance bill, and we start to put heads together on what we're lobbying for. The Nigerian Police Trust Fund Act has been dusted again. We had this one before, we've had it for years, enacted in June 2019, but the provisions for how to administer it were not clear. They're still not clear, but they've introduced some clarity to say that it is the FRS that would administer and collect the tax. And the tax is 0.05% of the net profit. Net profit not defined as well, but we believe that to be the profit before tax. But then again, or profit after tax, which gives us a lower figure. I would choose that if I were the one. All right. The Federal Inland Revenue Service Establishment Act as well empowers the tax authorities to be able to deploy third-party technology for tax administration. And that means they can come into your place and plug their system to your own platform and get information for the purpose of administering tax. That, of course, comes with a lot of issues around data breach, security of my servers, possible corruption, and all that. And what the law is trying to do is to say, okay, let's give you some day notice, because we do understand that this requires some talk internally with the technical or technology people before those kind of deployments can happen. And so there's a 30-day notice. There is also the opportunity for you to object once you're able to show good cause. Good cause isn't defined in the act, so you have to demonstrate that yourself. The onus will be on the taxpayer. In the absence of doing all of that, there would be a penalty for failure to allow the tax authorities deploy, which is 25,000 naira daily. The one thing to note is there have been updates around this where the tax authorities may be suggesting that the cost of deployment should be borne by the taxpayers. But that's also a good cause to push back, because you are not the one who brought up this law. They need to take responsibility and own the verb deploy and actively deploy their own assets, to the extent that it aligns obviously and doesn't cause substantial disruption to the company's activities. The other thing as well we see in the Establishment Act is that the FRS will solely administer, assess, and collect any tax for the federal government. This is a very welcome development, especially if you have been a victim of some of the numerous audits that agencies have come up with, whether it's at the assembly level or RAMFAC, Revenue Mobilization Commission, or EFCC sometimes have started doing audits as well. So this is saying that the FRS is solely to administer all of that. And on the back end, we would then have MOU signed with those agencies if they do want to gather additional information beyond what the FRS will really do. It also calls to question some of the practical concerns around if there are ongoing audits already by these agencies, do we put a stop to them? Yes, this absolutely stops it. But what it then means is how do we finalize that? So the FRS needs to carry on from there, and for subsequent audits from now, with the 1st of January 2022, it all has to be handled by the FRS. So you have a good base objecting to them. Contravention, you can see, attracts a fine of 10 million naira. Okay. I thought there was going to be more, and I finished just on the dot of time, 10:28. I just have about 2 minutes. So I think at this point, I will hand over to Ademola and Babatunde, just so we can go through the questions. Please feel free to raise your hands. Let's make this interactive as much as possible, and we can unmute you to speak. So over to you, Babatunde and Ademola.
Yeah, thank you very much, Esiri, for that insightful presentation. I just want to highlight some of the three key messages that came through to me. The first one is government is looking for money. You can see that through the increase of taxes, ensuring the FRS is the sole body for collecting taxes. The second thing is tax advocacy and tax lobbying. Right, we can see with the success that the minimum tax amendment brings to us, right, and the likelihood of a finance act coming in mid-year, there is enough scope, right, for advocacy and lobbying actions to be taken now. And lastly, I got a bit more insight, right, into the thought process of the lawmakers, right, on those issues, right, from the presentation. So if anybody wants to understand a bit more around this context, we have somebody here who was in the room when these conversations were happening. I can put more context to your understanding of the impact, right? So at this particular point in time, I would hand over to Demola to take us through the Q&A and contribution section of this webinar.
Thank you very much, Babatunde, and thank you, Esiri, and thank you very much for the beautiful presentation. There's really no doubt that the recent changes in the Nigerian tax environment calls so much for attention that all businesses really need to be up and doing with regards to the impact on their businesses. So, as Babatunde mentioned earlier, we're now in the Q&A session, and we would implore everyone to please drop your comments in the chat box, or you can signify by raising up your hands if you would like to speak, and would unmute you and call you to please take your questions. So I will just scroll through the chat box to see if we have questions there already. Okay, Esiri, we have an initial question for you. And the person did not indicate the company that he or she works for. The question says, given that the medium-sized companies are not exempt from income tax like small companies, are there measures in place to ensure that their capital allowances are not eroded based on the provisions of the Finance Act 2021? Siri, over to you.
Okay, I'm unmuted already. Don't mind me.
Okay.
All right, yes. So I think for medium companies who are taxed at a different rate, it's not like they're exempt anyway. There really should be room for them to carry forward their capital allowances and hopefully claim them at even a much reduced rate so that the tax impact is at 20% as opposed to the full 30%. So some apportioning needs to be had in that sense. And then you just freeze, the brought forward capital allowances to 2022, and those would be the pool that will sit still under the 20% bucket. Because the ultimate goal is we don't want you to double dip. So if you had calculated capital allowances at a time where you had exempt income, you can then use those same assets or the capital allowances that were derived from those assets to reduce the taxable income or the tax of the taxable income. The same thing, if we then begin to push forward for increased rate of tax, we should apportion also or prorate the manner in which those capital allowances should be claimed. So I believe that for medium companies, that argument has to be had, and we definitely need to communicate that to the tax authorities ahead of the returns to be filed.
Okay. Thank you very much, Esiri, and I trust that answers your question. There's a comment here from Agbeyi asking us to please send the slides for yesterday, today, and subsequent lectures, as well as the recorded lectures. Okay, thanks, Agbeyi. Would look into that. Esiri, we have another question for you.
Agbeyi. Okay. Go on.
Okay.
Go on.
Okay, we have another question for you, Esiri. Okay. My company produces sweetened non-alcoholic beverage that is not carbonated. Our view is that the 10 naira per liter excise duty should not apply to us. What is your take on this? My company produces sweetened. Okay. Please go ahead, Esiri. Yeah.
So, yes. So I had alluded to that in the session, where I said that it would appear, reading the exact wording of the law, that those three conditions need to be met, which would be that it is non-alcoholic, it is carbonated, and it is sweetened. However, you can also read it, the other way around to say that once it is non-alcoholic, whether or not it has carbon in it and whether or not it has sugar in it, it should also attract the excise duty. These are the two possible interpretations from the Act as it is. What position would the tax authorities like to take? Definitely, they would like the higher, which would be that you look at it individually, because then that gives them more volumes to assess excise duties on. But I think the ultimate, final position on this would be on the HS codes that would be used, because what tends to happen is the custom duties would then be responsible for assessing those, different from the FIRS. And the custom duties usually look at their green book, and the green book specifies what those HS codes are and tells you what those additional duties duties might be. So we expect that there will still be grays in this, but in the practical sense, it's the HS codes that would be the final cover on this. And hopefully we should get more regulations on the excise duties and the application in due course, because there are really so many questions coming up. And what I would really like is for you to start thinking about what your own concerns are. We are not in the industry in that sense. We don't manufacture the goods, but if you're in the manufacturing industry, start to ask yourselves those critical questions so that you don't get caught in that gray and you've pretty much sorted out what needs to be done before the assessment arises. Things like, when should I remit the tax? At what point should I remit the tax? Although there are answers to that, like I said, the Finance Act is not invalidating the existing act, is only amending it further. And so what you then need to look at would be the Customs and Excise Management Act, SEMA, which has provisions already on excise duties, how they should be assessed, on what price, at what point the payment should be made, the possible penalties as well. It will still equally apply in this case. Okay.
Thank you, Esiri.
Over to you, Ademola.
Yeah, thank you, Esiri. There's another question from the namesake Dracula. So I'm just going to read it. In practice, who is FRS targeting with this plugin technology? It makes sense. It makes some sense for VAT monitoring for some very big and highly computerized companies like telcos and large retail operations, but would be chaos for running of the medium and small companies. What have you been seeing in terms of who and how the FRS is targeting companies?
Yeah, that's a very great question that you raised, Dracula, and thank you for just sharing that, because that also gives us the opportunity to share insights as well with the entire group. So what we've seen, and like you've already alluded to in your question, is they actually are going after big companies. And the genesis of this also is coming through from companies that were providing services on digital platforms where the FRS does not have a view, of what is going on, and they want the information real time and online. At some point as well, they were even looking at airlines too, to the extent that there was no VAT exemption, that the airlines too, they needed to have access to what it was or what transactions were happening, so that those agency fees as well that go on between them and their agents, they could capture VAT at source. So these are some of the concerns. And so we expect that in practice, there would be more focus on the big companies, those in the telco space, those in the airline space as well, those in manufacturing, at least big manufacturers, to the extent that there would be significant revenues that they will have there. But again, for manufacturers, it's this way and that, because really the risk is not as high. You're making physical sales. And so what they just simply need would be the downloads on what your sales are and pretty much your turnover at the financial statements. But for those who are in the digital space, you don't have that kind of access. These are intangible products that are being sold. So I think the FRS will be glued on, accessing information on those type of companies more than the other categories. But that's not to exclude, other companies in these categories like hotels, what's their name now? Hotels, the health sector too. The health sector has, gotten a boom this period. So they might be looking at targeting the health sector in addition to these other sectors that I mentioned. But for small and medium-sized companies, no, it would be a waste of effort to do that, because the cost of collection then far exceeds the revenue that you're even trying to generate. And what exactly do you even want to plug into? Another group that might also be affected by this would be the betting companies, the lottery companies. Those would likely also be affected.
Thank you very much, Esiri. There's an additional question here from Ayo. I'll just try to summarize, from Adi rather. I'll try to summarize it. So Adi is asking that he understands that there is a possibility that the Minister of Finance would issue some directives regarding implementation of excise on non-alcoholic drink. And given that the Finance Act had commenced on 1st of January, and that directive by the Minister of Finance hasn't been issued, would it be nice to begin to accrue for for potential liabilities on the excise, or they should rather just wait till we have that directive from the Minister of Finance? So I do want to have your thoughts on this.
Okay, thank you, Ade, for asking the question. It's a good one too. You see, let me just give you my own experience from how this our government operates, right? So sometimes when you're even going through these rounds of amendments, sometimes we're privy to some of them and we get into those discussions, just before they then pass them into law. Believe it or not, you would then have that there are amendments that just shock you before your very eyes at the time when the final amendment is passed, because somebody just slipped something in. And that's basically what happened with the minimum tax. When last year, minimum tax was supposed to be for targeted years, but then the way it had been changed, the wording had been changed, could now be read retrospectively, which was not the intention. That wasn't the intention. So at the back of the legislators' minds, they had an intention, but that wasn't what was passed across because someone had gone there and changed it. So just looking at this as well, I mean, it's all well and good to hear this type of announcements that say there should be a transition, and it really is ideal under best practices to have a transition where you introduce a new tax. Just as we even had take example, the Petroleum Investment Act, where there were grandfathering provisions that were allowing companies to continue with the existing provisions under the Petroleum Profits Tax Act, as opposed to taking on board the PIA. But then that conversion, if you wanted to have it, needed to be clearly applied for, represented. That transition is laudable. However, we don't see that consistently with all taxes. So with the excise tax, if there is already this being said about the fact that there be a transition, I'd love to hear that, but I don't want to put my entire money or bet on this. And so what I would suggest is that you start already to accrue for that internally, start that process already. And if there really is a 90-day period and the effective date is prospective, as we would love to have, say from March, then you only need to release those. But you have to definitely start doing those simulations to let yourself know how this will impact the pricing of the goods that you're producing, and what kind of adjustments needs to be had. In fact, some of the options might be that there would be no increase in price, but there might be another line in your income statement that you then want to focus on and optimize because it's such a fractional amount. That may be the case. Or you decide that you want to make a small adjustment. That small adjustment needs to be quantified at the back of your mind. You therefore need to do those simulations early on. So I'll say start now to do those, accrue internally already, and wait until those announcements are made. If there really is a 90-day fixed period, then reverse those.
Thank you very much, Esiri, for that elaborate response. So I would still like to remind participants that you may please raise up your hands if you would like to ask your questions directly. Otherwise, please continue to drop your questions in the chat box. Okay, Siri, there's a general question. Well, maybe two in one, which I would also take together. This question is with respect to the Nigerian Police Trust Fund Act. So can the FIRS legally pursue collection of the Police Trust Fund levy from 2019 when the act was when it was enacted, or should it apply effectively from 2022 when the administrative framework was instituted by the Finance Act 2021? And closely related to that is someone raising a point that there was no definition of net profits in the act. So what should be taken as net profit? Thank you.
So this question is a great one. I like the fact that, at least there's something going to the fund of the police. But again, how that should have been funded is another question. Should it be an additional burden for companies? Why is the government not just taking that solely from maybe any federation account on other taxes that have been paid? You know, that's another discussion for another day, unfortunately. But I mean, just looking at it, you know, when there is an act, you know, when there's an enactment, there usually would be a commencement date. And with the police fund, you know, we had an enactment date from 2019 when the act came into being, January 2019. What we didn't have were the procedures or the administrative rules on how it would be collected, but also a deeper dive on how it would be assessed, which is why you've also raised the question of what really is the net profit. The net profit wasn't defined there. And those are some of the flaws that have been highlighted and we thought would be addressed in 2021, but it hasn't been fully addressed. What, however, has been addressed is that the FIRS can now collect this tax. If you were to ask me, when should we start to remit it from? Should it be from 2022, since this is when it came into being under the Act? I would say go really to 2019, because already some of you, I started accruing for that police fund act, because when I pick up any financials, I usually even see that act. And if you recall, unfortunately, I'd have to just raise these memories during the SARS revolution. Remember that there was a lot of calculation on what companies are even paying already into this police fund. So a lot of companies already accrued for it. Now we only need to remit it. So I believe that the tax authorities back as 2019. Fortunately, it is a fractional amount, so not something that will break the bank, I hope, or break your cash bucket, which is 0.05% of the net profit. We recommend using the profit after tax, and I believe that that's what a lot of companies have been using, you know, to compute those. So safe to say, use that and assume that the remission will be from 2019.
Thank you, Esiri. There's a question here from Ngozi, and she says, please elaborate on how the capital allowance restriction will be applied for a company that has pioneer status across its different production lines.
Okay, so great one, Ngozi. Thank you for asking that. For a pioneer company that has status, that pioneer status across its different production lines, it won't be any different from a standalone company that has to now do this analysis. But like we said before, the pioneer companies are excluded from this proration. So once you come out of the pioneer, all those assets that you acquired during the pioneer, save for disposals that were made during the period, you bring them in post-pioneer, day one, those assets are yours, okay? You calculate your capital allowances, you have a huge asset already that's sitting to be utilized. Those capital allowances, you know that what, 30% on income tax, 2% on assessable profit, with all those smaller ones now that we've mentioned, okay? So you would calculate your tax on that, you would take your capital allowances, will offset it against your profits as you normally would with a standalone company. If your other production lines are still in pioneer, you will not have to do what I have just mentioned. They will sit there, no capital allowance computation. At least the only reason you are doing the capital allowance computation perhaps is for the purpose of assessing what your deferred tax asset is, and you don't really need to do that anyway. You can just use your depreciation line to calculate your deferred tax asset. So those ones that are still out of in pioneer, you're not calculating any capital allowance for them. They sit pretty as they are. You wait until post-pioneer to enjoy them. But if at any point in time, you then start to get exempt income, you will now look at post-pioneer for any of those production lines, because you must have segmented profits and loss statements, as well as balance sheets for all your profit lines and production lines that are coming out of pioneer until such a time when the whole pioneer has expired, and then you can then combine them in one tax return. Now, each of those ones now, once you come out of that pioneer, you do your calculation, you ask yourself, is there any exempt income aside from my operating profits from my production line? If there is an exempt income, is that exempt income, what is it as a percentage of my total income? Does it exceed 20%? If it exceeds 20%, you must restrict your capital allowance claim. Now, to restrict that capital allowance claim, we ask yourself, which capital allowance will I restrict? All wonderful capital allowances that you brought from your pioneer period into the post-pioneer, that pool is what you're going to then use to test this. So you will take it, you will look at the percentage of your exempt income vis-a-vis income, and then you will reduce the capital allowance claim, and you won't utilize that in that year and going. So it will apply to you once you come out of the pioneer, but all that pool that you brought from the pioneer would then be tested at that point because it's assumed to have been acquired on the day post-pioneer. Hope that's clear. Ngozi.
Yeah, I trust that answers Ngozi's question. Thank you very much, Siri. More questions are coming directly to the host, and we have a question here talking about the increase in the TET rate and when the TET, when the increased rate should effectively apply. So should it apply to 2022 year of assessment or to 2022 financial year?
Yeah, so this one will apply to your 2022 year of assessment, not the financial year, because the act has already, taken effect from 1st January 2022. It affects all the returns that you file in this period. And remember that even for filing of companies' income tax, you do it on a preceding year basis. So the act is focused on 2022 year of assessment. The year preceding is 2021. So unfortunately, periods from 2021 will now be affected by this higher rate of 2.5%. It would have been fantastic if we could go with the calendar period, but unfortunately, I don't think there's much leeway in the act to argue for that. So it would be for your 2022 year of assessment.
Okay, thank you, Esiri. There is another question closely related to Dracula's earlier question, which says that what measures are in place to guide against data privacy breach, given the provisions that enable the FIRS to deploy its own and third-party technologies to taxpayers, ERPs? Hello, Siri. Would you like me to take the question again?
Yeah, yes.
Okay, so
No, I got the question.
Okay,
just I got the question. Yeah,
okay,
so there are two fantastic measures in the act now. Yeah, there are two measures that you can take at least. The one is, remember when I was talking about this introduction, I talked about if you're able to show good cause, you can actually deter the tax authorities from coming, and then they can extend whatever periods are required for any plugin. If that is of concern, that can actually be your good cause. And that needs to then be elaborated properly, working with your technology team, just so that you can pass that message across properly and there can be an extension. For instance, we did one last year for a company as related to VAT for the B2C group. And it was just very clear that having to do that without a transition period, deducting taxes from individuals or accounting for taxes from individuals without setting it up in the system wouldn't have worked, because they had to set up in the system so that they could distinguish between companies that would have deducted at source from companies that wouldn't deduct at source, and then in that bracket also identify the individuals who would be your B2C market. So that would have taken time. And under the OECD guidance, you actually need about 6 months transition time for new laws like that. That's best practice. So we went with all of that, showed good cause, and we actually did get an extension. So I don't think the tax authorities are dull of reasoning in that regard. And I believe that if you can show that good cause credibly, there should be an extension, or it should even be pushed forward. The second point as well is within the Act, there are actually penalties for tax officials who divulge information of the taxpayers. There is a penalty for those kind of contraventions, and I'm hoping that those will be effected judiciously for taxpayers who come complaining about any possible breaches. But obviously, the ultimate would really be with your own firewalls internally, and that constant test is required. It just definitely emphasizes the point around cybersecurity, but also ensuring that your information is now segmented and classified, and that in terms of the quality of the data that you have you done even a review of that quality of data? Have you evaluated it to say, oh, what is here that shouldn't be here, and what may be possibly leading? As much as possible, the general rule of thumb is keep your information to the minimal, only answer what is required of you. Don't divulge much more than that. Just go straight to the answer. Don't even give them more, because once you start to give more information beyond that, you start opening more doors for them to ask more, and then you possibly inadvertently could expose data that you shouldn't be exposing to the authorities. But you can't tell them not to do it because the law empowers them to.
Okay.
Yeah.
Yeah, thank you. Thank you very much, Esiri. I think we can still take one more question, and there is a question here from Titilayo, who is asking that, so my question is on capital allowance for small companies. What happens in a scenario where a company was a large company and had accumulated unrelieved capital allowances, but due to business performance, the company reported turnover less than 25 million in a particular year of assessment? Would the accumulated unrelieved capital allowances brought forward be lost, or can the company carry same forward to such a time when it becomes a large company?
This question is doing my head, turning, and I'm thinking, what's the best answer for this? I really to freeze and carry forward to when we become big companies, but the law is saying that you'd have to forfeit it when you become a small company. But again, can we resume, that claim when you then become a large company? I think it's something that definitely should happen, because even in other jurisdictions, what you then have is a pool that's segmented according to the different categories of assets and also how you can claim them. So those pools are admissible, for instance, in the UK. Why can't we also do that? So I think it's a question that we need to sit down and analyze together. And if it means reaching out to the authorities as well, we need to absolutely do that. So it is clear that we will carry this forward to such a time when we're large companies, because I don't believe that there is a restriction currently in the law. What it just says is that if you were a small company, whatever capital allowance accumulated, you cannot enjoy them when you're a big company. The reverse is the case. If you're a big company, whatever capital allowances you accumulated, then you can't use it as a small company. Obviously, there's no way you can utilize them. But if you're a medium company, you can utilize them at least to the rate of 20%. And if you're a big company again, then carry forward the rest. But I don't believe it should be forfeited. So that would be my position. And it's important that that is just further discussed as well with the authorities before you file, so that you know what your risk area is.
All right. Thank you very much, Esiri, for your responses, and thank you so much to our participants. We appreciate the engaging Q&A session, and I'd just like to remind everyone that the tax environment is constantly changing. So in as much as we keep on seeing all these complex issues, we should remember to seek professional advice where necessary. We should also proactively review our transactions so as to identify any tax risk that might be inherent in therein. So at this point, I would like to hand over to Babatunde Olani to help close the session. Thank you.
Yeah, thank you very much, Demola, and very special thanks to Esiri and Demola for this insightful session. Right. Thank you everyone again for sharing 1 hour of your morning with us. I would just like to close by saying, if you have any additional questions or you want to have deeper conversations, please feel free to reach out to the contacts on the invite to the webinar or your preferred PwC contact, and we'll be happy to take it forward from there. Right. Thank you very much again, and have a great rest of the day. Bye.
Bye. Thanks.